The United States didn't reach its current debt crisis overnight. For decades, the nation has relied on borrowing to fund its ambitions, from wars to social programs, infrastructure projects, and economic bailouts. Every time the government spends more than it collects in taxes, it borrows the difference by issuing treasury bonds, effectively promising future generations will pay for today's decisions. While debt itself isn't inherently dangerous, the pace at which the U.S. has accumulated it has become unsustainable. The turning points are clear. In the aftermath of World War II, debt was high but manageable because the economy was growing faster than the debt. Fast forward to the 1980s, and the combination of tax cuts, military expansion, and rising entitlement obligations began outpacing revenue. The 2008 financial crisis accelerated the trend, as trillions of dollars in bailouts and stimulus were injected into the system, creating a reliance on borrowed money rather than sustainable economic growth. Today, U.S. debt surpasses $35 trillion, and the national debt-to-GDP ratio is higher than at any point in peacetime history. This constant borrowing creates a dangerous feedback loop. Each new debt cycle relies on confidence that the U.S. can pay it back. If investors lose faith, interest rates rise, increasing the cost of debt and leaving less room for essential government spending. Ordinary citizens feel the pressure indirectly through inflation, higher taxes, and reduced public services. History has shown that no empire can grow its debt indefinitely without eventually facing a crisis. The U.S. is now approaching that threshold. The debt explosion has created a ticking time bomb, and the longer policymakers delay structural reforms, the closer the country gets to a financial reset that may reshape the economy forever. The U.S. debt curve is no ordinary line on a chart. It represents the future of the nation's financial stability. As the government borrows more, the cost of servicing that debt rises, creating a compounding problem that is difficult to reverse. Right now, the U.S. is paying hundreds of billions annually just in interest, and as global interest rates climb, that figure could soon escalate into trillions. The debt curve isn't linear, it's exponential. Every additional dollar borrowed today increases future obligations, and without significant economic growth or fiscal reform, the curve will eventually overwhelm the system. The mechanism is simple but dangerous. When debt grows faster than the economy, investors demand higher interest rates to compensate for risk. Higher rates make borrowing more expensive, which forces governments to either cut spending or issue even more debt to cover the interest. This cycle becomes self-reinforcing, and the debt curve accelerates. Ordinary citizens often don't see this directly, but the effects are visible in inflation, stagnant wages, and higher taxes. The wealth gap widens as ordinary Americans struggle while the system prioritizes maintaining confidence in government bonds. History provides a stark warning. Ancient empires, from Rome to France, faced similar debt spirals. They could sustain themselves while economic growth outpaced obligations. But when growth slowed, interest obligations spiraled out of control, leading to defaults, currency devaluations, and social unrest. The U.S. is now approaching a comparable point. The curve doesn't wait for political convenience, and the longer reforms are delayed, the sharper the correction will be. The debt curve isn't just a number. It is a ticking time bomb that could redefine the future of the American economy and the global financial system. The U.S. debt crisis is not an isolated problem. It reverberates across the entire global financial system. Because the dollar serves as the world's reserve currency, almost every country holds U.S. treasury bonds or uses the dollar in international trade. This creates a fragile dependency. When America struggles to service its debt or experiences inflation, other nations feel the impact almost immediately. Rising U.S. debt rates can increase borrowing costs worldwide, destabilize foreign markets, and trigger capital flight from emerging economies. Simply put, when the U.S. sneezes, the world catches a cold. Foreign investors, including central banks, hedge funds, and sovereign wealth funds, rely on the U.S. dollar as a stable store of value. But as debt grows, confidence wavers. If investors start demanding higher yields, the U.S. must pay more to borrow, which accelerates the debt curve further. Countries heavily invested in U.S. debt, like China and Japan, could face major losses if bond values drop or if inflation erodes the real value of their holdings. This interconnectedness creates a global domino effect where one misstep in American fiscal policy could cascade into worldwide financial turmoil. History again offers lessons. The collapse of empires and the defaults of sovereign nations often triggered international crises. The 2008 financial crash, for instance, was exacerbated by U.S. mortgage defaults that rippled globally. Today, the stakes are exponentially higher. The U.S. debt has surpassed $33 trillion, and global markets are far more interconnected. Any disruption to the U.S. debt market doesn't just threaten Americans, it threatens banks, pension funds, and entire economies across continents. The world's financial stability hinges on America's ability to manage its debt, yet political gridlock and excessive spending make the situation increasingly precarious. The debt curve is no longer just a domestic issue. It's a ticking bomb under the entire global economy. America's debt curve is not just a mathematical problem, it's a political one. Every year, Congress debates budgets, spending bills, and debt ceilings, often without long-term solutions. This political gridlock creates uncertainty in financial markets, making investors wary and driving up borrowing costs. The longer policymakers delay reforms, the steeper the debt curve becomes, leaving future generations with a heavier burden. Fiscal irresponsibility combined with partisan deadlock is effectively a ticking political clock that aligns perfectly with the economic time bomb. Debt growth is fueled by a combination of structural deficits, entitlements, and rising interest payments. Social Security, Medicare, and defense spending consume massive portions of the federal budget, leaving little room for discretionary investments. Meanwhile, tax revenues fluctuate with economic cycles, and emergency spending, such as stimulus packages, adds fuel to the fire. Politicians often prioritize short-term popularity over long-term fiscal stability, approving new spending without addressing the widening gap between obligations and revenue. This creates a dangerous feedback loop. More debt leads to more interest, which requires more borrowing, which leads to even higher debt. The consequences of political inaction are profound. Even small miscalculations or delays in addressing debt can magnify the risk of a financial crisis. Rating agencies may downgrade the U.S. credit rating, increasing borrowing costs further. Global confidence in the dollar could waver, prompting foreign investors to diversify into other currencies or assets. In essence, political gridlock doesn't just threaten domestic stability, it magnifies global risk. The time bomb isn't ticking silently. Every unresolved budget and deferred reform adds another second to a countdown that no one can pause. If policymakers fail to act decisively, the U.S. debt curve could force a financial reset that reshapes the domestic and global economy alike, whether anyone is ready for it or not. Once the U.S. debt curve reaches a critical point, the consequences will ripple across every corner of the economy. Interest payments alone could consume a majority of the federal budget, leaving little for infrastructure, defense, or social programs. Investors may lose faith, driving borrowing costs higher and accelerating the cycle toward collapse. This isn't a distant hypothetical. It's a structural inevitability if reforms are delayed further. The debt curve, combined with persistent deficits, functions like a loaded spring. Eventually, it must release, and when it does, the reset will be abrupt and disruptive. Global markets will feel the shock immediately. The dollar's dominance as the world's reserve currency could erode, and international lenders might demand higher returns or pull back entirely. Domestically, inflation could spike, and the government may resort to unconventional measures like currency devaluation or forced austerity. Ordinary citizens will feel the impact through rising prices, reduced social benefits, and a shrinking safety net. Wealth inequality could worsen, as those with assets can hedge against the fallout while the majority bear the brunt of the collapse. Yet, a reset also presents an opportunity. New financial systems, potentially digital or decentralized, could emerge. Debt restructuring could create a more sustainable economic framework if approached proactively rather than reactively. However, avoiding chaos requires awareness and preparation. Understanding the mechanics of the S. Debt curve is the first step in anticipating the inevitable reset and positioning oneself to survive and even thrive once the time bomb finally explodes.